All right, I'm Joey Kalski, and the topic I chose was topic number one, the golden parachute. The issue at hand here is should the government regulate and cap the amount of compensation that CEOs receive or leave it for the market to determine? So, some background on this topic. This topic is an ethical issue surrounding workers' compensation and economic inequality. Over the years, CEO compensation has grown exponentially in comparison to the average worker, which calls into question the fairness of allowing compensation to be determined by the market, or if the government should step in and start to regulate CEO compensation. So I do have a video here that I was going to share for this presentation, but then I realized that the screen recording app that I am using makes me have to pay to use the computer audio. So and it's a lot of money, so I wasn't able to do that. So when I send you the slides, hopefully you'll be able to watch that video. I can just break it down really briefly. Basically, just does like a really good job of like covering an unbiased view of the topic as a whole, just giving like facts and like a little bit of history. But yeah, so in a normal classroom setting, we would have watched that video. Um, yeah, so a little bit more. So the video did not have like super like up to date recent like statistics. I think they were from like 2010, so it's not that old, but these ones are more up to date as of 2018. So these statistics, um, the average CEO pay at the top 350 firms in the United States was 17.2 million a year, which equates to a CEO typical worker compensation ratio of 278 to 1, which has grown exponentially over the last like 75, 50 years or so. As in 1965, this ratio was only 20 to 1, and in 1989, it was 58 to 1. CEOs also make 5 times as much as the other top 1% of earners. So they're even making more money than their like income bracket, other people in their income bracket, I should say. Um, and then over the 30-year period of 78 to 2018, CEO compensation grew by over 1,000%, which outgrew the S&P 500 index stock index by about 300%. Um, like the wage growth of the very high earners bracket was about 339%, and then the typical worker only grew about 12%. So CEOs' wages are growing way more rapidly than other areas of the economy as well. And then this graph here just shows the figure of the CEOs making 278 times to 1 the typical worker, and it shows like the chart of how that's changed over the years. It topped out in the year 2000 about 386.4 to 1, which has came down a little bit since 2018, but still is a very large gap. So then one side of this argument is the argument for government regulation. So the pro of this would be that the government could regulate the CEO compensation structure and therefore protecting the economy. So the big downfall of the current compensation structure is in the stock options. A lot of times people think that CEOs act irrationally or in the short term so that the stock prices can move up in the time that they're CEO so they can become wealthy themselves. And then this kind of behavior like puts the shareholders at risk and also puts the economy in a bad spot because it makes the stock market really volatile and it makes them make decisions that are not necessarily good for the company or the economy long term, but more just for like themselves making money. Um, Another pro is that government regulation could redirect CEO compensation back to firm performance. Over the previous years, it's been a large complaint by the public that CEO compensation does not seem to reflect firm performance. Rather, it more reflects what other CEOs are making or kind of just trying to like leapfrog each other, which I'm actually going to talk about a little bit. Um, and then some cons of government regulation are that this could lead to more regulation into other sectors of the economy. So let's say they start regulating CEO salaries. What's going to prevent them from preventing the salaries from top actors or sports players, which I guess, I mean, they are kind of capped already by their leagues, but they're not capped in terms of endorsements. So like, let's say they say that they can't have a certain amount of endorsements to go over $100 million, something like that. So it could lead to a slippery slope that people might not want to go on. And then another con would be that historically the government regulations actually made CEO pay skyrocket even more. So starting in the 1980s, they tried to regulate CEO pay a bit, and actually since then skyrocketed even more because they start to companies started to come up with more creative ways to pay their CEOs that aren't just directly salary based like stock options. Um, then the second side of this is the argument against government regulation. One pro that this side sees is that it could continue to allow what individuals to be paid what their skills are worth across all levels of the economy. So this side of the argument would think that if CEO salaries are limited to a certain number, they might be like undervalued in terms of what their job title represents to the company. So if you have like a $100 billion company and your CEO makes $2 million, depending on what his job entails, he might be like considered undervalued for the actual worth he brings to the table. So this could then trickle down to other lower levels of the workforce. So another pro would be that CEO pay in the past has been proven by research that it's already self-correcting, and the market suggests that as well. So as CEO salaries come up and down depending on company performance, typically they self-correct, and the ones who perform well get the high salaries, and the ones who perform uh, the worst, I guess, get the lower salaries of the CEOs. Um, then some cons of the government not stepping in could be that the problem of leapfrogging could go unsolved. Um, so what leapfrogging is that CEOs get raises year to year that they don't seem to deserve. So let's say a CEO has a bad year, and they end up getting a raise because someone else with another company is making more than them. So then they ask the board of directors to get a raise so that they can make more than them. And then the board of directors say yes because it's hard for a board just to find a new CEO because it's very highly qualified position. So they end up getting raises and meeting demands that they don't necessarily, or that their performance doesn't necessarily say that they can have. Another con would be that shareholders would be less protected by the government. So with publicly traded companies, the government steps in to regulate things in order to protect the shareholders. So if the government doesn't step in here, the erratic behavior that has been seen in the past by shareholders with short-term goals being like the top priority and things that might affect the economy negatively in order for them to have gain. If that kind of behavior continues, it could put the shareholders at risk. So I'm just gonna go into like my thoughts and then a summary of the topic. Um, my position overall is against the government regulation. The main two issues I see with this: first, that the CEO caps could potentially cause CEOs to be like undervalued, and then if that trickles down to other areas, nobody's going to be happy because people are going to be getting underpaid for what their job entails. And then also the CEO salary regulation could cause more salary regulations in the future potentially, because what's to say that if they start regulating CEO salaries, they won't start doing it to actors or like other celebrities or other business people that aren't necessarily CEOs, but I guess it kind of becomes a slippery slope at that point. So then in summary, the numbers obviously don't lie. There is a very large wage gap between the CEOs and the lowest waged employees. Um, this is a problem, economic equality. It's definitely been an issue throughout the United States, which it is in, a lot of capitalist countries as well. So the numbers don't lie, and it'll be continuing to be a highly debated topic because of that, because both sides see it a different way. But also, when you're looking at it, it's important to consider both sides of the argument because there might be different aspects that you might not have thought of before. So, yeah, these are my sources, and thank you for watching. If you have any questions, feel free to email me, or if you need anything else, too, feel free. Yeah, so thank you very much. I'm going to stop this recording. There we go.